Hello and welcome to Switzer Investing TV. I'm Peter Switzer. Thanks for joining us. And if you're watching this program now, you are a Switzer Report subscriber. As of today, this TV program is only available to Switzer Report subscribers. I thank you for tuning in, and I hope you can tell all your friends and family how valuable this particular product is. Without any further ado, let's have a look at tonight's show. I've got Jun Bei Liu looking at the 8 stocks I write about in the Switzer Report today. These are all 20%ers, stocks that the analysts believe have 20% upside for the next year. And then Paul, Rickard and myself go through those 8 stocks and give our variety of views. Do we agree with the analysts? Are the gains likely or unlikely? That's the substance of our discussion. It's a bit like boom, doom, zoom without you guys asking any questions. So let's kick off now with Jun Bei Liu of Tribeca Alpha Plus. Thanks for joining us, Jun Bei Liu.
Thank you for having me, Peter. How are you doing?
Very good. Now, today I wrote a piece in the Switzer Report about stocks that have potential and the analysts like them. Most of the analysts think these stocks have 20% upside over the next year. And of course, analysts can be wrong, but it was a consensus view. And most of these stocks, most analysts liked. But I really want to see what you're thinking about these stocks right now. So the first one is one that's, to me, a no-brainer, but you may well see something I'm not seeing. CSL at $260. Is that a buy or not?
It's almost a screaming buy, to be honest. Do you need to re-record? Okay. CSL is a screaming buy at this point. Look, the company had a very tiny downgrade, not so much a downgrade, really just telling the analysts that they were way too bullish in terms of, the recovery from COVID-related disruption to blood collection. Now things are going very well. They just said, look, instead of growing at 30-40%, we're going to do 20 this year, but it's coming. It's just taking time. So for me, it's an incredible buy. It is the highest quality company listed in the ASX. It is a very strong balance sheet, and the next 3 years is probably will deliver the highest growth within the healthcare sector, and that growth is not linked to the economic activity. So very defensive stock for your portfolio. Now near term, there is a trial result coming out. It's somewhat negative, but it doesn't bode significant for this stock. So, for a lot of investors, they're sort of sitting back going, oh, one last negative news, let's wait till it go out of the way, and then let's buy it big time. But honestly, it is incredibly cheap at the moment.
Thought you might say that. Let's go to a company like ResMed. I've always liked it. I've always liked to buy it when the market goes against it. And it's kind of been a good strategy. What's your current feeling about ResMed?
Look, ResMed, I think it looks very cheap, especially, looks very cheap, and also heading into a result in the next couple of weeks. We have their quarterly result coming out, and from everyone we spoke to, we think the result will be very strong, particularly in terms of the margin, because they sold a lot of product in the last quarter, and then usually the second quarter is all the margin that's following up, which is the mask sale, which is high margin. So we think the result will be really good, and share price may well have a very strong rally around the result. Now, the challenge at the moment for this stock to consistently go higher is because people keep thinking, when is Philips going to come back? Because remember, ResMed took a lot of share out of Philips, and then so just a little bit holding back, saying, oh, how much share are they going to give back? So, that is keeping a bit of a lid on the stock, but net over the 12 months, you will be buying this company.
Okay. Let's go to the next one, and it's one that I know you do like, and that's IDP Education, IEL.
Look, I like this company. I think they already spoken to the market about how strong the student recovery is going to be. We're already seeing some part of it, and in the next couple of years, the pent-up demand is enormous. And this company is very leveraged to the student placement. Not to mention, it's not only just Australia. There's UK, there's Canada, there's around the world. It benefits from that student mobility, the opening border of the Chinese, Chinese students. So So that is very positive. Now, what's holding back the stock was really, the English testing in Canada. They lost the monopoly, and that from September onwards, there will be another testing regime. So market's a bit worried about how much market share they will lose. Look, net, it's a lower margin business, a lower multiple business. And to us, you buy this company for the, to leverage to the student placement business. And it is a buy at this point, and the result is going to be well anticipated.
Okay, here's a company I've never talked to you about before, but it's in the logistics space. There's a company called Cube. What are you thinking about Cube?
Look, the company is underperformed somewhat. It is very much being impacted by a lot of weather and other things. Looking forward next 12 months, the valuation looks reasonable, and some of the weather, it will start cycling the better weather outlook. So to me, it's more of a hold than rushing out, because to me, I like company that will grow, that will consistently do well, and as part of the portfolio. So this one is more of a value decision, and I think it would deliver pretty good high single-digit return.
I don't recall you ever talking about energy stocks, but maybe I'm wrong. Santos is a chronic underperformer, but I have been reading that the oil price is expected to rise for the rest of this year. Is Santos a buy at these levels?
Look, Santos has been the value stock choice or selection of choice for investors. It is a buy, but I would much rather to buy the Woodside. For me, I like to be, even though Woodside is more expensive, but I just think it's better, less accident prone and better assets, and I much rather buy into that one. Now, the whole oil segment has been under quite a lot of pressure. Well, pretty much because oil price was under pressure, everyone worried about the global recession. But now we can see the recession has been pushed out further and further. And it certainly seems like every other cyclical sector has rallied, but oil hasn't. And with the oil prices actually heading higher, I do think the oil names looks really good, but I would put my money in the Woodside.
Yeah. It's like you're going for the Rolls Royce of energy companies. One final one. This is a company that was once rejected by BHP, but has been doing pretty well. South32. Have you got an opinion of South32?
Look, I think the South32 is it's in an okay space, but under a bit of pressure because of the globally when people worry about global slowdown and recession, the demand for aluminium or alumina will start to be under pressure because less consumable white goods that's to be made. But this company is doing okay, and if you look at the prices, the commodity prices have yet to cover because China is still going through that slow recovery, nothing like what is expected, but there's a lot of people expecting more stimulus out of China. So, that company may well have some leverage to it. But look, for China, you probably want more of the iron ore exposure. You want the lithium exposure to get a bit more, more return to gain benefit from the high stimulus.
Okay. So you mentioned lithium. Do you think the lithium share prices of the star performing companies like the Lion Towns and whatever, do you think they're going to keep rising over time?
Yeah, it certainly seems so at the moment, because if you just look at the supply and demand imbalance, there's just so much demand. You look at Tesla, this week, Tesla are going to report a growth of over 40% in revenue, despite cutting the prices significantly. You look at the beyond the Chinese EV business, it's going to report, I think this week as well, over threefold of its earnings growth. So, there's enormous amount of EV demand just across all these businesses, and at the moment technology still requires all the lithium battery to be produced. So until we have a better technology, whether it's a Sunlight and the others, it seems like lithium is still the way to go. And those companies, particularly the ones already producing and making money, they are making so much money. So I would be much rather sitting in the ones producing and generating all the the cash flow than the early stage ones where they're still trying to find production or trying to get it out of the ground. So for me, PLS is the place to go.
Great stuff. Jun Bei Liu, thanks for joining us. See you in a couple of weeks' time.
Thank you very much.
That's Jun Bei Liu of Tribeca Alpha Plus. Well, today in the Switzer report, I looked at a number of stocks. I called them 20%ers, ones where the average consensus rise of the analysts was around 20%. And I want to run these by Paul, and we have a bit of a discussion about whether we think these companies are worth following. So Paul, g'day, how are you?
Good, thanks, Pete. Let's roll into your.
This is like a Monday version of Boom, Doom, Zoom, but no one's asking questions apart from me. Let's kick off the first one. And I made the point that sometimes you have to have patience with companies. And you and I, you particularly liked Xero, so and I like Megaport, and you kind of teased me occasionally when it didn't come good, but you saw the merit of it, and both of them have come back really strongly. And I want to try and find some companies like those that have that potential to come back over the next year or so.
Yeah, I think we see this more and more, Pete, that particularly the market seems to go these phases. Sector rotation seems to be a big thing, and if anything, all the institutions almost sort of get on a board at the same time.
Yeah.
And of course, when they're going into a new sector, they're getting out of something else, and often that comes out of the States and we just follow, but it seems to be more of happens more often today than it did, say, 5 years ago. So I think that tends to create opportunities for stocks that remain unloved. But I guess the warning is they can be unloved for a long time, quite a period of time.
Okay, let's kick off the one that I thought was a screaming buy. Jun Bei Liu on this television program said the same thing. CSL. You have always been a CSL fan, but is it a screaming buy at 260?
Well, it's hit a 52-week low last Thursday and again on Friday, and I was really quite staggered. Clearly, there's been some institutional selling post its trading update in late June. I thought it had sort of found a bottom around $280, and all of a sudden last week, Peter, it just sort of tumbled again. I think it's got to be, in that buy zone right now.
Yep, I agree.
I'd like to see the institutional selling stop and to find a base around 260 and do some work before it goes up, and you could say that's the bottom.
Yep.
I'm not sure that's the risk at the moment, but I guess you're going to have to be patient. I mean, healthcare stocks generally, until last Friday in the States, but have been out of vogue. It's been seen as a little bit in the US as a defensive sector. You made that point. In Australia, though, our healthcare stocks are much more growth orientated.
Yeah.
And maybe they don't get the credit they deserve sometimes for being that way. But healthcare hasn't really been that fashionable in the US, and I think we've paid the price here a bit.
Yeah, and UBS and Citi agree with us. They see a 30% gain out there, and I think they're going to be right over time. Okay, let's go to the next one, Paul. ResMed. ResMed, here the experts think about 18.8% rise on average. What do you think of ResMed?
Yeah, I really like the company. Not doing a lot at the moment, Pete. It's sort of $32-ish, $33. Certainly hasn't gone for the fall that CSL's gone through.
No.
I guess the only trouble with ResMed is twofold. One is I see, although most of ResMed's income is offshore, I always get a bit worried when you see them advertising locally to mums and dads. Yeah. Not that it's not a mums and dads product.
It is, isn't it? Yeah.
But you wonder whether that makes it harder to get, getting sort of consumer traction can be pretty hard when you're self-marketing. But two, I think, as you mentioned in your article today, Pete, one of the reasons ResMed has done okay the last 12 months is that some of its competitors have been struggling, and there's always that risk that one of those competitors comes back into the market again. Yeah. So I'm probably, it wasn't that long ago ResMed was an $8 stock. Over the last sort of 6-7 years, it's become a $35 stock, even as high as the low 40s. So it's had a terrific run. A stock for the portfolio, I probably prefer CSL to ResMed at these prices.
Yeah, but me too. But it's worth noting it because I think it is a good quality company. Yeah, it might only be a 10% gain, but still it's a good company. You can make that. IDP Education, I've got to say, most of my fund managers and brokers I talk to love it. You're a bit suspicious of it.
Yeah, just because everyone seems to love it, it's not going up, Pete. Look, I don't have a strong view one way or the other. It's probably, for me, I just hear too many good things and I don't see enough action in the share price.
Yeah. And Morgan Stanley expects a 42.54% gain. Let's hope they're right if you're holding it. I don't think I actually do have it in my portfolio, but I am tempted because a lot of people are telling me how good it is. Let's go to one I've never really even considered. Who was the guy who started Cube? Chris
Corrigan.
Chris Corrigan, yeah.
Of course, after
the ports battle.
Battle or during the ports battle, or where it was.
But he did make a lot of money over his time, a great investment banker in his own right. Cube Holdings, a 20% gainer on average. Citi says 32% high, Orbinet 27%. What do you think about Cube?
Look, I don't know a lot. I'm not a stock I've ever owned or really been that close to. But I always, when you see sort of what you describe as industrials, pretty solid companies like that, with analysts tipping big price rises, I'd probably take a notice of that one.
Yeah.
And do my work and get a lot more interested in it.
And it's in logistics as well.
Yeah, which is not as volatile. I mean, it should be a reasonably defensive industrial in some ways. So I think take heed of what the analysts are saying and maybe one to look at for the portfolio. All
right, South 32. I remember when I got spun off, you were pretty negative on South 32, like this is a reject from BHP. But it's kind of done pretty well, hasn't it?
Well, it was a reject. It's now, I think it's been around almost 20 years. I think it was 96.
Really? 20
Maybe
years?
It's not. Look, it's a long time ago since it was spun off from BHP, and it was the assets BHP didn't want. But some of those assets, things like nickel and manganese and other things, are coming back into vogue again, right?
Yeah.
So
everything old is new again. Yeah.
Everything old is new again. So it's ended up with some assets that, as the rush to electric vehicles and greener ways of doing things. Yeah. Some of those minerals are actually now quite high in demand. Yeah. So look, I think one to look at. It's in January it was got close to $5. It's now back about $3.80. I can see why the analysts are looking upside. Obviously, it needs a strong economy, like all the commodity stocks. It needs growth, global growth to support it. Yeah. But I think it's well positioned, Pete. It's just you got to be. I probably prefer others in that area, but
if you got BHP and Fortescue and Rio, it might be the next cab off the rank from those sort of stock standard stuff. But you're right, nickel's in there, and
it's got coal assets, it's got aluminium, zinc, a whole lot of things. It's quite a diversified set of commodities.
It is. Yeah, so it's worth thinking about. Who's the most optimistic? Morgan sees a 41% rise. Let's go to Santos. Now, a great poor performer at Santos. Once again, the gains are quite encouraging. What do you reckon?
Well, I wrote an article about 12 months back saying Santos was a screaming buy compared to Woodside, right?
Right, yeah.
And, of course, exactly the opposite happened. Woodside continued to go up, Santos didn't do anything.
And you broke your own rule, didn't you? You bought the second best in the sector.
Now, actually, I have to say, in the last few months, Santos has come back up a little bit and Woodside's come down. So some of that gap has narrowed. But for all the reasons you're saying, Santos looked quite attractive. I guess I'm still a bit jaded by that, Pete, because I think that's also what the analysts think, that there's more value in Santos than Woodside. Yeah. Look, probably prefer Woodside simply because I know it, I trust it a little bit more. Yeah. It's the preference in the market, but certainly, I think most of the analysts see that if you're looking for a stock in the energy business, Santos would be their pick compared to Woodside.
Okay. Here's a company I never thought I would write about, but all the analysts liked it. It surprised me. TPG.
Yeah, been burnt on TPG. It's now in the fours. It was once a $9 stock when it was out there competing, against
Telstra and
against Telstra as rather than sort of the merged entity with Vodafone.
Yeah. And it lost a key founder, didn't it?
It did. Yeah, it was all run by Tio. Not
Charlie Tio. The other Tio.
The other Tio, right?
Yeah.
And apologies to both, I guess. Yeah. He sort of then sold out following the Vodafone merger or Vodafone takeover. Yeah. Pretty quickly and dumped all his holdings, and it's really been in a rut ever since. Now, one of the things in that space that's good is there's now only 3 competitors. Yep. Really just Telstra, Optus and TPG. Optus has its problems because of long-term brand damage from its recent thing. and we've seen mobile pricing plans pretty stable. So TPG's got knocked down recently because the ACCC won't let it do its sort of plan in the bush with Telstra, which I think is a pity. But look, I guess in the 4s, it's probably starting to look interesting.
Yeah.
Right? Because it was a company in the 8s and 9s.
Yeah.
It's the number 3 player with a pretty good strong share in a very, there's no competition in that market really now. It's all gone, right?
So this might be a question you can't answer, Paul. iiNet.
Yeah, they're part of it.
Yeah, I thought so. Yeah, and they advertise really well.
Yeah, they had some great brands that got sort of smashed into Vodafone, and someone might say that Vodafone's killed it.
Yeah.
But who knows, right?
Yeah.
We're not close enough. So.
Okay.
But look, I think in the 4s there's probably upside in that company. I really like Telstra, and in the period that Telstra's been going up, TPG has been sinking. So maybe that's almost look at the switch potentially out of Telstra back, or out of some of your Telstra into TPG.
Yeah, bit of profit taking, go to TPG. The last one, and I was surprised that the potential average rise was so high. Treasury Wine Estates, I think it's a great company. Wasn't quite 20% on average, but there are some analysts who think it's 20% plus gains in the year ahead. What do you think?
Yeah, I'm in the TWE camp. I noticed there was an analyst, one of the analysts did do a downgrade last week on TWE. But again, one of those companies, a bit of a trading update, a bit of a problem in the US market. A glut of wine is probably having to sell wine at a lower price. Suggestions that perhaps because of consumer discretionary spending here, maybe a bit of a glut developing locally. Not sure that's quite true, but I think this is a stock, put in the portfolio, lock away. TWE will be a lot higher in 12 to 18 months.
Yeah, and the bottom line is, even if it only goes up 7 or 8%, 7 or 8% is a good return for a stock.
I mean, they proved during, bear in mind the whole China market's been closed to them. It still remains closed.
Yeah.
And this, that's one of the big, reasons why there could be a re-rating at some stage if that market opens up. And I guess you've got to say, given what's happening between Australia and China at a political level, it probably will get opened up.
Yeah, things are getting a bit better, aren't they?
Yeah.
Without a doubt. All right, Paul, that's a good coverage of those stocks. If you want to read more, it was in my story today in the Switzer Report. Thanks for joining us. And that's the show for tonight. Thanks for joining us. Remember, this is a program now exclusively for Switzer Report subscribers. I look forward to seeing you on Monday next week.